Well, now, it is Vlogtober, I guess. That's what they're calling it. Welcome to the Solomon Project, where it's not how much you make, it's how much you keep that counts. Right? Right. I'm your host, Richard Burns. And that's exactly what we're trying to do. Keep our money. What do you guys know about bonds? Yeah, bonds. Well, bonds are a type of investment. However, instead of buying something, well, see, that's these people are slick. Nomenclature, semantics, derivation of words, See, it's funny because you buy a bond. You can buy a corporate bond, right? You can buy a bond from corporations that actually sell bonds. It could be GlaxoSmithKline. It could be Tesla. It can be Coca-Cola, IBM. You can buy a bond. Buying a bond, what you're actually doing is lending money. You're lending money. It's funny how they put that word buy in there, when the truth is you're lending that corporation money. When you buy a bond from the United States government, you're actually lending the United States money. You could lend a town money by buying their bonds. You could lend a state money by buying their bonds. So you got corporate bonds, you got government bonds. And they all don't have the same risk profile. They all have different risk profiles. Different corporations that sell bonds are rated differently from one another. It all depends on their ability to pay back that bond, that loan that you gave them. And bonds have what's called a maturity date. It can be weeks, months, years. So for example, I can buy a bond. Let's just keep it simple here. I could buy a federal bond, a U.S. bond. Let's say it's $1,000. I'm lending the federal government $1,000. Well, how long am I going to lend it to them for? So basically, you're being like the bank. You're going to lend out this money for a determined period of time. Could be a month. So they're going to pay you back your $1,000 plus interest in that month. That's the expectation. Again, the risk for one particular type of bond or wherever it is that you're lending, their risk profile will be different from another risk profile. If you want to go, for example, from state to state, you can buy a bond from New York State, or you can buy a bond from West Virginia. The rating agencies determine how risky it is for you to lend these two states money. The rating agencies might rate New York State AA, and West Virginia, they might rate it a double B. So what does that mean? Well, A is the highest. So if you lend New York, which is a double A money, it's safer than lending West Virginia money, which is double B or triple B or single B or a C or double C. And it keeps going down. The lower the letter, the closer it is to what we call a junk bond. They're called junk bonds because there's a high probability that that bond will be worth nothing, will turn to junk. You might lose the money that you loaned whoever it is. I'm keeping it as simple as I possibly can. So if you get a bond, if you purchase a bond from a triple A rated or an A rated person, or company or government that wants to borrow your money, then the likelihood that you'll get the interest plus whatever you loaned them is very high. Because it's very high, the interest that they're going to offer is very low. If the rating is very low, then it's just the opposite. The amount of interest that they're going to offer is very high. Whatever very high means. Could be double digits. Could be 15%, could be 20%, could be 30%. So the relationship with the amount of interest that they're going to pay out is the higher they're willing to offer for interest, the higher or riskier it is. High interest offer equals high risk. Low interest offer equals low risk. And you can purchase bonds from other countries, other cities. You gotta look at the interest that's being offered. Is it high? Is it double digits? Because if it is, it's riskier than a source that's paying a lower interest. There are bonds that offer you 2%, 1.5%, and you might be asking yourself, why would you do that? Why would you buy a bond that's offering 1%, 2%? Investors may be looking around for a place to park their money. Investors, individuals who understand how money works, corporations, they may want to keep their money in something other than a bank because the bank offers such a low amount of interest that The person or the corporation would want an alternative to that. And one alternative can be bonds. And one of the safest bonds are U.S. Treasury bonds. Because they are so safe, it's not just American citizens that purchase U.S. bonds. You get individuals from all over the world purchasing U.S. bonds. You get governments from all over the world purchasing U.S. bonds. And the bond market happens to be 4 times bigger than our stock market. The fact that there are so many different countries that lend the U.S. money by way of bonds, and not just government bonds, but corporate bonds as well. That's why the bond market is so huge, 4 times bigger. Individuals like to manage their risks by having a diversified portfolio. Remember, we spoke about diversification. Basically, it means not putting all your eggs in one basket. So you could diversify in the stock market by having a portfolio with different corporations that you're buying shares from. But you can expand that diversification by also including bonds in your portfolio. I'm not a bond fan. I'm not big on bonds. But if you feel the need to have to put some money somewhere else other than a bank, then bonds may be an alternative. Just a thought. This is not financial advice, but it's a definite thought. Some go so far as to diversify their portfolio by including works of art. Most wealthy, or at least the wealthy people that I met, they are cash poor and asset rich. So they don't have a lot of cash laying around. They keep most of their money invested in something. They'll keep their money invested in works of art, in bonds, in stocks, because they want to put their money to work. They want to keep as much of their money working as opposed to just laying around. If they need to purchase something that's outside of their budget, and that's another thing that the wealthy do. They have a budget. They keep a budget. And everybody here can do the same thing. One of the greatest things about this country is that you can participate in the same investments, at least today, that the wealthy participate in. I know I got family in Europe. They can't purchase stocks directly from the stock market. They have to go through a bank. So their money is getting snatched up through bank fees. Not just transaction fees, but bank fees as well. And yet here in the United States, you can open up a trading app or download a trading app, open up a trading account or an investment account, and you can buy and sell whatever stock you want to buy without having a third party in between. Some people feel that they need it, and that's fine. That's actually a more traditional approach. But some people are able to pick and choose and also utilize strategies outside of buying and selling stock to enhance their returns. Okay, so I just wanted to remind you guys of that. Listen, it's Vlogtober, so stay fresh and keep it profitable out here. Kitty, come pick these people up.
Arabam Dacia, seviyorum çift kalem aça. Göremedi kimseden fayda, işler